Tom. I'm here with Joel Rumney from Grant Thornton here in Midland. Really lucky to have a few minutes of your time, Joel, so thanks for being here. I'm going to let you do a little intro of yourself, and then we'll have a chat.
Sounds good. Thanks, Paul. Thanks for having me. So I'm a partner at Grant Thornton, Canada, located in the office here in Midland. I'm a business advisor, but I spend most of my time doing corporate and personal tax planning for high net worth clients.
Again, thanks for your time. We're coming to the end of 2021. It's been a phenomenal year from a market perspective. A strange year, once again, as we're dealing with this COVID stuff. Any advice, or maybe what are you seeing with your clients kind of coming into the end of the year as tax planning, business planning? What are some of the things we should be taking into consideration?
Yeah, a lot of the focus this year and in previous years as well is on the anticipated changes in taxation around capital gains. So what is a capital gain is probably the important thing to cover first. So a capital gain is where you've acquired a stock or security for a certain amount of money. And as Paul was saying, the market has done tremendously well. And so it's worth more today than what you paid for. So the difference from what you paid to what it's worth now is called a capital gain. And today, 50% of that amount is taxable when you sell the investment. So if you continue to hold it, if it's in the portfolio with Paul, that's an unrealized gain, just a paper gain. But when you sell it and repurpose that capital, you then have tax issues, some tax exposure. So the reason why we talk about capital gains today is today may be thought of as the good old days, a short time from now. So 50% of the gain goes into income to be taxed. The other 50% goes into your pocket. And so that's a pretty good deal when we compare that taxation to other forms of income. And so it's important to talk about capital gains in your portfolio, both corporate portfolios and personal portfolios, because tomorrow, and by tomorrow I mean next year or the following year, there could be more tax to pay. It could be a higher rate at that point in time. So it could be a great time to talk to your advisor, your tax advisor, and your investment advisor about whether it makes sense to realize capital gains now. That could be to sell the investment and to buy it back, and just to really pick your tax rate in the tax bracket system at today's capital gain rates.
Yeah, and I mean, maybe historically, when those changes have occurred, what kind of heads up is given to someone to know, okay, we're at a 50% inclusion rate, it's going to move to 75%. Could that be something that just happens as an overnight where we don't get a heads up?
Yeah, there have been some rumors. I mean, we're talking about 3 years of conversations that have been going on with the pandemic being in the middle and halting things. Historically, we haven't seen a change in capital gain taxation in decades, right? So it's been 50% for a very long time. What we're hearing now is that what we usually see is a change in the future. So it might be January 1st, for example. But being towards the end of December now, or the middle of December, before holiday season, there hasn't been much talk about it at all. So the wonder is, could they go back in time and say, okay, today's Friday, well, Thursday was the last day for a 50% capital gain treatment. So it's really hard to say, but I will say that, if they do make a change at some point to capital gains taxation, many will wish they triggered capital gains previous.
Yeah. I mean, that's great advice. And to that point, that's one of the things that we're saying to all of our clients is let's sit down and have a look at this coming into the year end. Let's have a look at this, obviously, because that could be a concern, something that could take place. And due to a great run of the market as we've seen, obviously that could pose an issue. It's a good problem to have those gains, but it's still a problem.
Yeah.
I know one of the other things that I wanted to bring up or for us to chat about is corporately owned life insurance. So this is a strategy that we use with lots of our incorporated clients. And essentially what that is that the corporation owns and pays for a life insurance policy on the insured. Is there still merit for these? And is this something that, when we're looking at them, on your tax planning side and business planning side, when you see a proposal for these, what are maybe some of the things that are pros or cons associated with them?
Yeah, so I look at a corporate owned insurance policy as one of many buckets. Okay, so when we think of somebody's assets, we look at the corporate investment account, we look at corporate owned life insurance in a lot of cases, the tax-free savings account, RRSPs as well. So the reason why we want to multiply buckets is the taxation around these buckets is different. So as our needs change later on in life, our cash flow tends to change. So if you have a client that wants to tour around the world and one year needs a lot more cash than another year, it's nice to be able to have that flexibility to pick from different buckets rather than just one. So specifically on the corporate owned insurance policy, what's nice about it is you're taking corporate cash, investing it inside of a policy, and there's no taxation on the growth of the cash value over time. It's more of an asset that you look to your estate for in terms of it's going to pass along in a very tax efficient manner to the beneficiaries of your estate on your passing.
Yeah.
Right. So that's where it's really attractive. It tends to be an asset that's added once other buckets are starting to be filled. Right. So you wouldn't necessarily go right for the insurance policy right away.
Exactly.
You wait till the other buckets are slowly being filled and you say, now this is a good idea because I have excess corporate cash.
Yep.
Or investments, and it's time to put that into a new bucket.
Yeah, I mean, our approach with everyone, anytime we're looking at that, is it a piece of your plan, or should it be a part of what's there? Yeah. Certainly shouldn't be the whole thing.
Right.
But historically, or even looking into the future, to me, it's one of those things that there is still some merit in at least exercising that process of, does this fit my financial plan?
Yeah,
for sure.
Absolutely.
Well, Joel, this has been as expected, lots of great information. Thank you so much for your time. Thank you for the chat. And until the next time we have a chance to sit down.
Thanks, Paul.
Thank you.